Welcome to episode 10, where we're going to talk about the recent superannuation changes and how that superannuation actually affects everybody, young or old. So it's not just for the ones about to retire. These changes are going to have an impact. Firstly, the amount that you can put into super as a tax deductible amount has dropped from $30,000 to $35,000 to just $25,000 from the 1st of July 2017. It's important to note, and this goes through for every year that super contributions are made, don't wait until the last minute to put the money in, because the superannuation must be receipted by the superannuation fund on or before the 30th of June. A lot of people, because it's electronic and everything else, believe, oh, I'll just do it on the last day, it'll be receipted, everything else. It must be at the other end. Even if you can prove it went out of your bank account on the 30th of June, unless the super fund confirms it, you will be denied that tax deduction. It'll fall into the next year. Also, from the 1st of July 2018, so we're going another year down the track, those dentists who have got a superannuation balance of less than $500,000 will be able to make catch-up contributions. And by that, the government is looking at, if people miss out on making their $25,000 deduction or whatever they've made, up to a 5-year period, they can do a catch-up. So if, for example, you didn't put any money in this year, didn't put any in next year or the year after, and we've got to year 4, and now you do have enough money to put in, you can catch up on those 3 earlier years and put $100,000 into super. This means you haven't locked your money away, but you've still been able to take advantage of doing a bit of a catch-up, which I think is a good thing. It can also have a tax planning aspect in that if you weren't putting some money in, you were getting into a practice or you're doing something else, and you found that in a particular year you had a large capital gain or you had a large amount of income in one year for particular circumstances, that would be the year to do the catch-up and get a $100,000 tax deduction where it's very valuable to you. The other rule that a lot of people didn't know about is what's known as a substantially self-employed rule. What happened is this caught a number of people where they were both an employee dentist and they were also contracting. For them to be able to get a tax deduction for their super contribution, they had to be substantially self-employed, which means that no more than 10% of their income could come from employment-related activities. So often, people who may have just done some work in the public system on the weekends or were engaged privately somewhere during the course of the year where they were an employee rather than a contractor, often missed out on their tax deduction almost through no fault of their own because they were getting a salary or wage somewhere else, and that was more than 10%. That has now gone so that you will get a tax deduction irrespective of whether it's a 50-50 split or even whether you're 90% an employee and just do a bit of contracting work because it's convenient to do so. I think that's a good thing for everyone to be able to maximise their super contributions and plan for their retirement. The bit that is catching a lot of dentists is what's known as a Division 293 tax. This is tax levied against high income earners where their income was over $300,000. This has now been dropped to $250,000, so that they need to pay an additional 15% tax on that extra super contribution. That tax can be paid either by yourself or through the superannuation fund. Most of my clients that do get hit with this additional tax are choosing to pay it themselves so that they keep as much money in their superannuation fund as possible. Also, non-concessional superannuation contributions have fallen from $180,000 to now $100,000 per year. Non-concessional are where you do not claim a tax deduction for that amount. You would be putting those amounts in if you wanted to boost your superannuation balance. Some of our dentists who are looking to potentially buy their dental surgery building in a self-managed super fund, maybe trying to build that balance up so they've got a reasonable amount there to allow their super fund to be able to buy it. So they may wish to put non-tax deductible super contributions into their fund. As I said, it's now restricted to $100,000 per year, but up to age 65, you can bring forward a future 2 years contributions. So you can make a $300,000 contribution. Obviously, you can't then make any further non-deductible contributions in the next 2 years, but does allow you to get a lump in, and that $300,000 is per member in the fund. So if there's 2 of you in your fund, each of you could put potentially $300,000 in to boost that balance. The real bit that everyone's talking about is this $1.6 million cap. This is happening when a superannuation fund goes into pension mode. So this is typically when you retire, and under the rules, when a superannuation fund goes into pension mode, it means that all of the income that's being earned by that fund is actually tax-free. The fund pays no tax. Now, in the past, and we've had funds that have $10 million or more in there, this was fantastic. You could be generating income off $10 million worth of assets, paying 0 tax on that amount, and anything that you drew out was also tax-free. You were living in a tax-free world, given how much money you had in your superannuation fund. Now it's going to be capped at $1.6 million. But it doesn't mean that you can't have more in your super fund. What it means is, if you did have $10 million in your fund, $1.6 million of it will still get that tax-free benefit on the earnings from those assets. The other $8.4 million that's left over can stay in the fund, but it will continue to be taxed at 15%. At 15%, I think that's a pretty good tax rate to be able to have in your superannuation fund, and certainly better than having the $8.4 million in assets outside super, where you would be paying significantly more than 15% on those earnings. So that 1.6 is just a cap on that tax-free. The other bit to remember is it's only related to the earnings within the fund. So if you did have 10 million in the fund, the bit you take out on the 1.6 side as pension, and the bit that you would take out as a lump sum out of the 8.4, both of those in your hands are still tax-free. So it's still a really good system. We've just put a little bit of a cap on it. Lastly, if you are getting close to retirement, you may want to enter into what's known as a transition to retirement pension. These were very effective ways to actually phase out over a period of time, draw down a bit of pension and put some more money into your fund. Obviously, the incentive for doing that was that the earnings in your fund in this transition phase were going into were not having any tax deducted from them. There is no $1.6 million limit on these transition to retirement pension, but in the fund, transition to retirement pensions in full will be subject to this 15% tax. Money you take out will still be a tax-free pension, but across the board, everything on a transition to retirement pension will still be subject to that 15% tax.
I've got a number of clients who will only just get to the 1.6 million in super. What tax planning should they do now?
Because the first thing to look at is, if both people reach the $1.6 million, then what happens on death? Because if it gets transferred to the other person, they're now going to be over the $1.6 million mark. So there's a bit of planning to be had, or an awareness that needs to be there regarding that issue. Also, during the build up to that 1.6 million each, you also want both parties to try and be as evenly matched as possible. So it's something to be aware of, and it's something to be progressively planning.
With all of these changes, people are getting disillusioned with super. Should a dentist just ignore super and concentrate on investing directly in property and shares?
Right, Alison, a lot of people are getting disillusioned with super, but it's like trying to strike a balance between what you hold outside and inside of super. Not to forget that superannuation is at a reduced income tax rate or tax rate, so it's well worthwhile having your investments inside super and also some outside. But also, it's legally protected when those assets are inside super, so if a dentist were to be sued, those assets are in fact protected.
With all of these changes, do any of the tax rules affect self-managed super funds differently to industry super funds?
I know that's a really good question because a lot of people do concentrate on the self-managed superannuation side, but no, the tax rules are universal. They will affect all members of all superannuation funds, whether they're in an industry fund or whether it's a self-managed superannuation fund. Obviously, if you're trustee of a self-managed super fund, you need to be well aware of the new tax rules or ensure that your accountant and financial advisor are aware of those rules to ensure that you do comply.
I hope you got some valuable information out of that, and as you can understand, this superannuation area is extremely complex. So always, when you're considering superannuation, get appropriate advice, whether that be from an accountant or a financial planner. Also, look forward to the next lot of episodes that we will be doing, and we will be having some guest speakers at those to give you even more information that's pertinent to the dental industry.